Good morning, everybody, and thanks for joining us for this week's session of Your Voice and Open Q&A with me, Whitey. And we look forward to having you with us this morning and with our special guests. We'll come to them in a minute. But most importantly, first thing, I hope you've got your coffee ready to drink. And this week, my wife has made me some great banana bread, which I've already hooked into. So looking forward to that. So anyhow, get your coffee, relax in your lounge chair, and before we move on, I'd better say a big thank you to our sponsors who support us in all that we're doing with the FBAA. They're great people, and they're there to support you as well in the industry. So without them, we don't get too far. It's excellent to have them on board, but especially through these strange times that we're in. Anyhow, thanks to our sponsors, they're always great. Well, this morning, I want to welcome very special guests to us. Our friends from AFCA are joining us. We have Evelyn, and Evelyn is the lead ombudsman for banking and finance, and Tim, who's the executive general manager of resolutions. Please welcome Evelyn and Tim. Thanks for joining us, guys.
Thanks for having us.
Very good. Excellent. All righty. Well, you know, our ombudsman is so extremely important to all that we do within the mortgage broking world, and also within lending and financial services generally. And the role of the ombudsman is there, obviously, it's there to assist consumers with free access to be able to deal and to resolve matters. And sometimes those things get a little bit tense, and that's life. But it'd be interesting just for us to be able to have that opportunity this morning to talk to you about what's happening in the world of AFCA, knowing that AFCA is still relatively young, if you like, from a business point of view, based on being an amalgamation of past ombudsman services to create AFCA. I guess, when we're in this really strange time of the COVID-19 crisis, I guess your role in trying to navigate all this would be a little bit complicated. Are you able to talk through with us what are the sort of things that are happening in AFCA's role or in AFCA's world in navigating COVID-19?
Yeah, it certainly is an interesting time. I think the adjectives here most commonly are challenging and unprecedented, and we would certainly agree with that. So from our perspective, we probably have what's going on internally, then what's going on in terms of interactions with consumers and our members, and also how we're responding to the broader external environment. So internally, we moved pretty quickly to a 100% working from home arrangement. We had a few hiccups, as you'd expect, in the early days.
I don't think you're on your own with that.
Struggling with the NBN at his house, so they're ongoing. But it was really just our call centres getting that sort of continuity of having the call systems up and running at the front line. That was the toughest piece. But we're really up and running at really fully operational status now, which is great because it does mean there's not that gap. So that's been good. We've also been, I think, the key point for us has just been communication. We've recognised the need to be as flexible as we can in dealing with people, both in terms of, we went to ASIC and suggested extending the time frame for financial firms to provide their initial response to us. So that's been extended from 21 days to 30 days. And ASIC likewise were very accommodating and acknowledging the concerns that people have in terms of trying to respond to regulators at this point in time, while also dealing with the significant disruption that surrounds them. We've also telling all our staff to be really flexible in terms of any ongoing requests, to recognise that it may be harder to source information, it may take longer, things like signing documents and so on may be challenging. So really just trying to adopt a very flexible and reasonable approach day to day. We've also engaged really heavily with peak bodies such as yourselves. We've been speaking with the ABA, with COBA, with AFCA, we've been with the Debt Buyers Association. So just a lot of communication to understand how industry is seeing the market and what the different issues and challenges might be. We're also in close contact with the regulators, with Treasury, with ASIC, and really with the banks, really as everyone just works to try and work through together the new challenges we're faced with. And it's been really collaborative and cooperative. We've found all those engagements to be really positive, which I think has been, as far as you can take positives out of this, really challenging experience. It's been great. Everyone really has been trying to work together to find solutions to new kinds of problems.
Are you seeing any uplift in complaints during this period? Because it's one of those things you sort of think, I know for us as an association, we've had a steep drop in complaints, but generally speaking, I don't know what AFCA are generally seeing.
Look, it's fascinating. We are watching our complaints day to day, both business as usual and specifically COVID-19 related complaints. And there have been some things you don't expect. Like you say, some things go up, some things go down. I might hand over to Tim. He's right on top of the stats and he can give a bit of a feel for what we've been seeing.
Yeah, thanks, Evelyn. Yeah, look, it's an excellent question, Peter, because we have been seeing some pretty strong increases in complaints, particularly in travel insurance complaints. And the profile of those sorts of matters has also changed. So in March, February and March, the profile of those matters were more questions from consumers about whether or not they should cancel travel and what that would mean for their policy. Once travel lockdowns really happened across the globe, that decision was somewhat taken away from consumers. So it moved to much more of a claims-based type of matter that would be coming to AFCA. So our travel insurance claims complaints, really increased. We've sort of received half a year's worth of those sorts of complaints in the last 3 months. And that number continues to be quite strong. But to your point, we're also seeing a decrease in complaints in other areas as well. And that indicates to us that the community is really trying to reorganise themselves about what's important to them, and it has dried up some traffic. So we're seeing some ups and downs, but it's a tricky time for us to predict what's in front of it.
Yeah, I can imagine. Yeah, sorry, Evelyn.
Another key aspect, which I'm sure everyone's wondering about, is the financial hardship complaints. The early indicators were in travel and in financial hardship. We have seen the initial influx of complaints, although really, as we know, with the lenders just being overwhelmed with those initial volumes of calls to the hardship lines, a lot of the initial inflows coming into us are really just about, I can't get through to my bank, and much about the response that's been provided. And so we'll start to see those be resolved. They're not what you'd sort of call a substantive complaint. It's when people were sitting on the phone to the majors for sometimes 4 hours, they've just started like lodging everywhere, calling everyone.
That would be an interesting juggle from a business point of view, because I guess with the history of an ombudsman service, there's a certain normal flow of business and how things run along the line. Then all of a sudden you get hit with this, and you've got to regather call centres, and as you say, the complaints aren't so much about a specific issue outside of I can't get through, and I've experienced that myself. I'm talking about Tim. You're talking about travel. I do an extensive amount of travel. I'm regularly booked out 4 to 6 months in advance. Fortunately, this year didn't quite start the same, and so I think I burnt through maybe 100,000 points. I said, too hard. I'm not going to worry about that. But yeah, it's interesting because I tried to get through on call centres and couldn't, but found the online portals very helpful, I must admit, and managed to sort things that way. But yeah, it's interesting how quickly everything had to move to change to something that, when we ran into this, you look back 2 weeks before it started and the world was pretty normal, and all of a sudden within a couple of weeks everything had changed and everybody's trying to change everything with it. It must be, and knowing the size of AFCA's business transactionally, all power to, because that would have been a monumental exercise to get on top of it, I must admit. So yeah, it's interesting times.
It will be quite interesting to see how it goes, and we've been really impressed by how different pockets of the sector have responded, because operations just aren't set up to deal with these extraordinary peaks in activity. So everyone's had to adapt in different ways, and we've seen some really novel, great solutions which have helped people out. But we're quite fortunate at AFCA because we have sites in Sydney, we have sites in Melbourne. They operate in a way which is somewhat remotely anyway. So we just used that that setup and translated that into a home-based setup so we could quickly get our people to safety.
Yeah, and you'd have a reasonably sized staff team as well to then relocate that into home base. I mean, I must admit, you guys adapting to that in such a quick manner would have been a very a monumental task administratively to coordinate and to get it operating. So and so you've got everybody working from home. And are you finding that turnaround times are still similar, or have things got a bit congested with some of those additional inquiries around I can't get through to them? How are you finding that?
So far, things are looking okay. So in terms of our people and their productivity, we're not really seeing any significant impediments to our people staying busy and being on top of things, which is terrific. It's quite a different work experience for a lot of our team members who are very used to working within offices. And so working from home for such an extended period of time is quite a novel thing. Many people didn't have their houses set up to really do it easily, so we had to get quite creative and get chairs and monitors and keyboards and mouses to people's homes to help them be able to continue to contribute towards what we're trying to do at AFCA. So all in all, things are doing okay. I mean, the areas that we think will be busy are not yet busy, and we're certainly positioning ourselves in the right sort of way so we're best ready to go once the volume of complaints, which we expect to receive, arrive.
Yeah, excellent. And so how are you going dealing with the financial firms? Are there challenges there that you're working through? We talked a bit about timelines already. Will processes be modified, do you think? And are there any specific concerns that are being raised at the moment?
Yeah, so I think it varies very much between firms, and we're really conscious, as you say, of the incredible diversity of our members, from sole traders to some of the largest organisations in the country. And it is interesting that some of the bigger organisations actually suffered more initially. People who had significant off-site call centres in Manila or in India, and significant IT infrastructure overseas, some of those, their operations were really challenged, in that short term, and they're having to redirect people from different areas. I mean, it's interesting. We've seen a lot of firms, they have almost put a pause on debt collection, and they've pulled over all the people in those areas to work on the front line with just those thousands and thousands of hardship requests. So, as Tim says, it's been a bit of agility. I think it is surprising, the unexpected consequences. I mean, one example in the finance area, we expected the financial hardship complaints. And I suppose when I say complaints, they're not necessarily things we've got. We're talking, all the time to the biggest banks and insurers and to peak bodies. So we're trying to see what's coming to them before it comes to us. We expected the financial hardship, but they're getting a lot of inquiries, complaints about break costs. So when people want to move from fixed rate to variable, and there's a break cost, people are saying, I don't want to have to pay that. So can you just waive that? So that's perhaps one we didn't foresee, but that has been, insurers are saying, look, theft claims have gone down, motor vehicles have gone down, but accidental damage has gone up because the kids are running around the house knocking over all the TVs or whatever. So it's just really interesting, like the unexpected consequences. For us, the key is we literally, look at our incoming day by day. So if there is something changing, we can pick that up early and then sort of redirect.
Yeah, that's it's interesting with the kids here. So we're ready to send our kids back to school. Let me tell you, the sooner the better. Thanks for that. So, talk to me a little about how complaints are running at the moment. I know we've talked about certain areas. I've talked about, Tim, you're talking about the travel area and so on. Are there any specific concerns or what you expect to see going forward from the complaints that are happening at the moment, and timeframes to respond? Are they still pretty much the same, or are they a bit protracted? And I might have missed that before, so apologies. But what's happening there?
Yeah, so our timeframes are we're dealing with things pretty much to the same timeframes, but we're recognising when firms or when consumers might not be able to respond to the same timeframes, and that you know, sometimes the firms will be saying, look, we're putting all our focus on helping people, you know, directly, and so the complaints might be a bit slower, which, you know, obviously we can understand. That's where the resources need to go to helping people with the most need most immediately, and to the extent they can help people there, you know, that's going to reduce the number of complaints that end up coming through to us, which is a good thing. So the time frame there, yeah, sometimes there's an impact.
There is an interesting commentary evolving in the marketplace that I don't know if it's reached yourselves as yet, but it'd be interesting to get a little bit of feedback on is what happens to borrowers that are waiting to settle a loan, and all of a sudden the lender pulls out. And the big impact is in a purchase where they've outlaid a whole lot of costs, they've laid down a deposit, and all of a sudden they get impacted, or their employment gets impacted by COVID. The lender says, oh, geez, well, you no longer got a job, we're going to pull the funding, which the lenders have the right to do under their normal contracts. I could have a different moral debate about that. We might park that one for another day. But yeah, I can see a bit of a groundswell, depending on how long we stay in this for. There'd be a whole lot of people that are trying to settle loans that can't, and have lost significant amounts of money, which I imagine will then be raised within yourselves. Would that fall into your terms of reference, do you think, or is that then, you know, is it outside?
No, it definitely does fall into our terms of reference, and we have been having discussions around some of those issues, both the settlements that were in train and also new lending to consumers who might have been impacted by COVID-19 in various ways. AFCA actually put out quite a helpful response yesterday to the ABA, who'd raised some specific questions about each of those matters. Certainly at AFCA, we don't make the law or prescribe the regulation, but we do obviously have to deal with the individual complaints as they come in day by day. We said, you know, we'll follow very much the guidance that AFCA put forward, which we think is actually quite helpful. And I mean, specifically around things like loans that were partway through, or you know, settlements that were waiting. It's really a question of what's the overall harm. So the lender, as you say, will have a right to exercise. You might have to look at whether that's an appropriate response, is it proportionate, and that will depend very much on the individual circumstance in terms of what's the impact been to that consumer, and what will the impact be if you don't settle. Obviously, if you have a subject to finance condition, it will be quite different from if a consumer failing to settle is actually going to be a breach, you know, of that contract of sale with the vendor and expose them to further liability. So we really think it's that holistic view of the circumstances to really try to be reasonable. And I think, you know, I've done a number of joint forums with ASIC, and really the overriding message is the law and the regulation is flexible. It focuses very much on what's reasonable, with an overriding sense of where's the consumer harm, where's the risk of consumer harm, and that's what we should be looking to avoid.
Yeah, it is, and it's a really tricky position, and to me, it's always got to be case by case. But you know, we're not seeing huge amounts of it. We are seeing these things happen, and worried about what happens if this continues and it trends out. You know, and people potentially losing, like I said, lots of money, as well as purchases and all sorts of challenges that come out of that. And then the potential hardship that's going to cause on them financially if there isn't a fair and balanced play out the back end of it. Anyhow, it is a tricky thing.
The other thing that we are keen to emphasise is it's about communication. Like the lenders really communicating with the borrower. You know, don't just sit there and make an isolated assessment. Have a discussion. What's happening? You know, what's your question? And then, you know, document that. I think just that communication piece is super important.
Yeah, and look, you know, it's great you say that, because it's a fundamental piece in lending, and I've been in the industry now some 42 years. It has always been the case. If there's a difficulty with something, or things have gone off the rails a bit, first thing you gotta do is communicate. You gotta speak to someone, and if you don't, you try and hibernate. All you do is escalate the issue and ingrain that problem to a point that's really hard to then deal with, versus dealing with it up front and moving on. Hey, one of the interesting things I was looking at, and a piece of information you sent through this morning, was the number of complaints against mortgage brokers. And I know well, you have somewhere around 75,000 odd complaints in a year, is that right?
Yeah.
Yeah. Wow, I mean, that's a lot. For any business, that's a lot to get through, because it's just not a number. Each one takes a significant amount of time. So the man hours would be phenomenal. The pleasing thing from my point of view, if I can put it in that frame, is that there's only, looks like 264 complaints against mortgage brokers over the past 12 months. I'd rather that be zero, don't get me wrong. But I'm pleased to see that that represents somewhere around 0.35% of all complaints, roughly, you guys see, which from an industry association point, and somebody's been in the game for a while, is is comforting. The world's not perfect. Brokers are not perfect. We make mistakes as well. Borrowers make mistakes. It's a playing field out there, without creating blame to anyone. But is there, within the complaints you see to mortgage brokers, is there an atypical complaint? Is it more weighted about something than something else? Is there any feeling as to how that weighting goes?
I mean, I think most of the complaints, if I can put it that way, are around the information that's provided in applications, around accuracy of expenses of assets, etc. I think that's where a lot of the complaints are about. Often a complaint will be against the lender and or the broker, just depending. Sometimes you can't quite work out where the issue is, or the consumer can't work out where the issue is. And we have to work out whether it was on the consumer side, the broker, or the lender, or a combination of everybody. Sometimes it's just a miscommunication. So that one is pretty common. I think after that, it would probably be just claims about misrepresentation. So where there's been a misunderstanding or miscommunication about the terms of what might happen, or the one we see quite a bit at the moment is actually where people are now rolling over from interest only to P&I, and people are coming back and saying, I didn't understand that, or I thought that it would automatically be renewed my interest only period. And so, there's some issues there around, just, and obviously sometimes it can be a bit of a he said, she said, but probably those concerns around just a misunderstanding of what the terms of the product were, that can be an issue too.
Sure. And I don't know how much of this you've seen, because you're busy enough as it is, but within ASIC's initial provisionings around best interest duty, and looking at the draft RG versus when that, I imagine, is still going to come out in May as a formal regulatory guide. But there's a fair degree of emphasis by ASIC around educating the broker. Do you think that will, sorry, the borrower, I should say, not the broker. So the broker educating the borrower. Do you see that would go some way to answering some of the issues you're seeing within the complaints?
Yeah, I do think education and communication is really key. And I think, sometimes people assume knowledge, and as we know from the various financial literacy surveys that have been done, you really can't assume a very high level of knowledge. It's also something we've been talking to banks about at the moment in terms of some of the relief packages that are being offered. As you will have seen, the media likes to talk about repayment holidays, whereas we'd understand it's not a holiday in the sense you never have to pay that. It's just a deferral. And I think, we could potentially see issues down the track when people come to the end of some of those 3-month or 6-month periods, and suddenly they find out that no, the interest is being capitalised or the loan term is being extended. If that hasn't been explained to them really clearly up front, again, you're just going to get that potential mismatch between what the understanding is and what's been offered, particularly when people are, in a state of stress at the time as well and less able to understand. So we're trying to say to people to have fact sheets and FAQs and everything outlined really simply. that's going to again reduce hopefully the number of problems that arise down the track.
Yeah, because I mean, some of the things that get talked around the industry, and you know, it's potentially urban myth stuff, but a lot of the industry talks about, you know, they feel that the case managers are actually coaching people how to restructure or to structure their complaints. But yeah, like I said, that's probably as much urgent myth as it is potentially helping them through the process of the system. But obviously the data from mortgage broking isn't showing, it certainly doesn't appear to be increasing in my mind from historic data that I'd seen in the last 6 months. So that's a really good thing. We've got some data up on the screen there in regards to the last 12 months of operation. Did you want to add anything further to that one? If not, we'll move on to the next chart. So we've got a couple of charts here we can talk about for people. Did you want to add anything to that one?
We thought it was just helpful to give your members an overview of, you know, what it is we've been seeing and doing. So you see up there the 75,000 complaints over 12 months. Interesting point is it's really consistent. So the figure of sort of 6.5 month to month has been really consistent since AFCA started, really. And you know, they're the figures. We're actually watching the day-by-day figures now to see what the impact of COVID-19 is. This data was all pretty much up to just before coronavirus hit, so you know, it's a good comparison.
Yeah. Interested with the number of complaints, again, significant numbers, but I think, is that generally the normal amount of complaints per year an ombudsman would see, or is it rising?
Look, it's risen definitely in terms of when we combined FOS and CIO, we didn't really know completely what we would see. We also added in the superannuation jurisdiction from the SCTs, again a variable. And then we had the Royal Commission, so it was a little bit difficult to, you know, forecast exactly what that might look like. I think our complaint volumes are around 40% up on what FOS and CIO had been managing. So it is a significant increase, but at the same time, it doesn't seem to be increasing further. It seems to have formed a new normal. I mean, we've been curious to see whether that would start to ease off as the Royal Commission faded into memory. Although with all the sort of scandals in the press, AUSTRAC and those sorts of things, it stayed sort of front of mind. I guess as ASIC brings prosecutions out of the Royal Commission, it hasn't really eased off yet. And I think now we never really know because you've got COVID-19 is a big factor. So, you know, it does skew the data a bit, but yeah, it's pretty stable as we see it now.
I noticed on the next slide that we've got here, where we start looking at credit. Do you want to talk us through this one a little bit, and then we'll jump through the next couple of slides as well?
Yeah, so credit is a significant part of our business, 44% of our overall complaints. I guess the issues there, we just looked at what are the most common issues. I have to say credit reporting comes up the top, but that's because we report by issue, not by complaint. So if any complaint brings in credit reporting, it'll appear in that figure. So you might have a complaint which is actually about financial hardship. There's been credit reporting involved, that'll come into that stat. So it's deceptive in that we're not overwhelmed by credit reporting complaints. It's just an issue that we often look at. I suppose the key are the main ones there are responsive lending and responses to financial hardship. Financial hardship is the one that we have seen steadily increasing even before coronavirus. And I think, which was interesting because, you know, there was still pretty good employment, low inflation, low interest rates. But I think it was really just that, you know, stagnant wage growth, increasing utility costs. We've sort of seen that pincer movement is actually coming through in our financial disability complaints, even though the broader economy still looks relatively untroubled. But yeah, that's one we expect to see moving in the next 6 months.
Okay, excellent. And you got some data there on ADIs as well, on deposit taking. Again, unauthorised transactions sitting at the top of that list here. What sort of thing is that? Is that fraud? Is that what that infers?
Yeah, it can be. Basically, anytime someone says, you know, this transaction was made on my credit card and that wasn't me, so anything of that nature. mistaken internet payments, we have separate. Unauthorized transactions can also be scams, so romance scams, internet scams. Yeah, it's a range of conduct. But really, anytime someone says no, that wasn't me making that transaction.
Yeah. Okay. And in the next slide, we've got about payment systems. Again, we're talking about unauthorized transactions. Would that be scam things as well then, by the sounds of that?
Yeah, again, that's similar. And it's really the distinction is really around the provider and what. So this is, this brings in people like PayPal, etc. as well. So any concerns around, which obviously is really transaction based. So that's what you'd expect to see, that people questioning the transactions.
Excellent. Okay, well, that completes those slides. Is there anything else you want to get across to the people who are watching that you feel are important things they need to look at when people are looking at raising EDR-style complaints and how they manage that with their borrowers or their clients?
Yeah, I suppose, it might sound surprising, but we're really in the business of minimising complaints. So we don't want to see complaints coming to us as much as people can resolve them themselves initially. I think, that's going to be more effective. I think communication is really key, having those good discussions. I think also people being aware that they can raise concerns, directly with their broker rather than feeling they have to go elsewhere. We certainly, even most of our complaints, I think 80% come through online, and on our forms we're always suggesting people go back to your provider first, go back to the firm, because that's the simplest and easiest way to actually resolve things. Tim, did you want to add anything to what advice we give on the line?
Yeah, look, I'm happy to. I mean, I guess the best thing to do is to stay connected with your customers. Like that's best practice when it comes to complaint resolution or even avoiding complaints occurring in the first place. I guess picking up on the very, very low numbers that we're seeing from the broker network, I think that a lot of that can probably be pinned down to the sort of business that your members are engaged in. It's a referral-based business. Relationships are really, really important for that business to be sustainable over a period of time. And it's that sort of approach to dealing with problems, like connecting with people and sorting things out in the best way possible, that resolves matters before they become bigger matters, or also assists matters in being resolved with AFCA if they do make their way to us as well. So let us know, any complications that you may be facing if there's a matter with us, and we'll certainly work with those complications to the best of our ability. But to Evelyn's point, our approach is to try to connect the parties together to see if we can find a way forward that works for everyone. Otherwise, we'll provide an outcome which will give direction to what we think the right sort of outcome should be.
Excellent. All right. Well, look, thank you both for joining us this morning on this series of Q&A with Whitey. Really much appreciate it. And big round of applause from everybody watching. It's a silent one, sorry about that. But thanks very much. Really appreciate your time, and it's been a pleasure having you with us and the information you've given us this morning. So thanks so much. We'll see you again soon.
Thank you. And we really appreciate me to have this chance to engage directly. So thank you for inviting us. It's been fantastic.
Thanks very much. All right, thank you. And we might move on to some questions that we now have that have been asked for us this week that are non-AFCA related. And we'll remove that from our screen. There we go. And I guess one thing I do want to say is that I know we see many challenges from members and from brokers in general about dealings with AFCA. There's a lot of people and a lot of complaints, and so I guess with a new business as such as a combined ombudsman, they've had challenges, I would imagine, and they are genuinely trying to get on top of it. I personally engaged with the chair of AFCA in probably the back end of the second quarter of last year, and then again with the CEO of AFCA. Been wonderfully helpful to the discussions that we wanted to have, talking about terms of reference and things that seem to be viewed that weren't inside that terms of reference, talking around things where case manager after case manager seems to be involved and things getting protracted, the appearance of it being just a regime to charge more fees and things like that. And we've spoken at length with the executives within AFCA around those things, which is why I didn't bring it up this morning, and because we've already been through all that with them, and they are working to ensure that these things play out properly. And I would suggest if you are having an issue with AFCA and you're a member of the FBAA, because I can't step outside of that really, send me an email and I'll see what I can do to help, because we have communications with them. The AFCA is generally there trying to help, because they're there to review complaints by consumers that fit within their terms of reference. So they've got a job to do as well. But if you think something is not being looked at the right way, and I've had a few of these come to me and I've put them to AFCA and they have looked at them, and we have been able to move things forward. So don't hesitate to reach out, and I personally will do what I can to assist you in anything like that with AFCA. And I know we like to probably throw some stones at them, but at times, but they are generally trying to do what they need to do in their job and to get the right outcomes. So let's move on from AFCA conversations, and let's deal with a few of the questions that came through this past week. So one of the questions I've got here says, hi Peter, at settlement everybody gets paid but the poor broker. Why can't banks pay commissions quicker? Well, I guess firstly, it's a question for your aggregator to tackle their lenders on. It's a commercial thing, I guess. But I don't disagree. I mean, the disbursements are made to everybody at the point of time in settlement. But I guess a part of, if we look at the structure of interest rates and why brokers get paid what they do, they get paid out of a percentage of the marginalisation within the rate, as all expenses do for the lenders from that regard. So I guess that, you know, the banks are saying, well, we've not get paid anything at this stage. We've paid everything out. We don't start to get paid until the borrower starts to make their repayments. That's when the interest starts to realise, so the profit starts to come through, even though there's no profit in the early stages. So you're on a bit of a drip, like the bank's on a bit of a drip. Whether I completely agree with that or not, that is to me why I doubt you'll see banks paying commissions quicker. But that said, some of the non-bank marketplace do. They pay as a disbursement and settlement known it. So if they can do it, why can't others? It's a good question. Go dive bomb your aggregator, Andrew, and drill them a little bit harder. So unfortunately, we're not involved in the commercial component of the transaction. But I think there's some reasonableness around what you're saying, because I am seeing drags on commissions being paid upwards of 6 to 8 weeks after settlement. I think that is way too long. I think it should be a reset at the end of each month and cleared out either monthly, maybe even fortnightly. That's just my view of the world, but I'm not a lender, and they probably are all knifing me for that comment, but that's how you get that. I've got another question here about what is the FBAA doing about making trail assignable? Well, I can say right up front on this question, Max, nothing, because no one's actually ever mentioned it to me until you have, but you make a very good point. Talks about how good brokers carrying on a business, their clients, they look after their loans. Bad brokers or brokers not really doing the right thing, just get money for nothing as such. And that's where people like the Productivity Commissioner and Royal Commissioners have slabbers with various Senate inquiries have had similar commentaries around money for nothing, which we know it's not. It's there to do something. But you know, is there, the conversation is around, is there a consideration for a trail to be assigned from one broker to another? At the moment, the answer is no, and as pointed out here. But it's an interesting thought. Should it be that if somebody's not prepared to maintain the service to their client after settlement, whether or not trail potentially can be negotiated and sold on to somebody else? Now, you can buy portfolios, but that's when people are exiting the industry. I don't have an answer for that, to be honest with you, but it is an interesting discussion that probably shouldn't be shied away from. Another question here about when is the net of offset policy going to change? It ain't. The net of offset provisioning that came out as a part of ASIC's 516 remuneration review, which is where that all started from, and what came through from the Royal Commission and got discussed through the Productivity Commission. Net of offset was one of those things that needed to play out that way as a part of losing potentially a lot worse than what could have happened from then. The big thing to me, and there's competition laws that create challenges with this, and we've been trying to deal with it since last year through the Combined Industry Forum, was doing great work around this, but again, also had to get to a point where it stopped because of competition law, is that trying to get all the lenders to actually pay in a consistent manner. There are so many different variations on the theme as to how net of offset gets paid or undrawn balances. We really need, in an industry point of view, to have a consistency and agreed consistency with that. And that's really up to the lenders to get together. We tried to petition Treasury to get involved. They sort of did, but sort of didn't want to. Again, competition law, it's a commercial thing. And I kind of hope that the lenders will turn around and independent of one another, so they don't breach competition law, but make common sense informed decisions as to how net of offset should be paid. And the other question here from Ben is there any indication about how a pause in home loans, I imagine that means during the COVID-19 period, are affecting applicants' future chances for finance applications? I guess we're a bit early to know on that, and one would think that we would hope there would be no impact, because it is a certain point in time due to a certain set of circumstances that nobody had control over. So, you know, when you look at credit impairment and that side of the equation, it's all about, I did something wrong, I didn't pay my bill, I'm the one to blame as such, generally speaking. Whereas COVID-19 is, wow, this was outside of my control. My employer, you know, put me off work, I went on job seeker, or I'm still working, but I'm on reduced income or time, whatever it may be. But it was not my fault. And it wasn't even my company's fault, or my employer's fault. This is something that happened globally. So I very much hope, and conversations I've had at senior executive levels within regulators and so on, that the expectation is that it will play out fairly as a circumstance and consequence of a specific point in time that was outside anyone's control. Time will tell, but that's where we hope it will lie. And that goes into the next question as well, will banks change their credit checks and payment histories for 6 months going forward? I believe they will all be parked into a box as such that says, well, yeah, this was all COVID-19 related. We need to treat that fairly and put it over there and look at how this person normally conducts their lending and their repayment history outside of something that hit the world on a global scale. I have a question here from Anne about, do I think banks will toughen credit even further? I think we're in a period where banks have obviously tightened credit, but I think they get to a point where they find they over-tighten the screws, and this is a reflection of history, then it backs off a bit. I would have expected the back off would be happening now. The only problem is COVID-19. So that's created a little bit more tightening in areas, especially on household expenditure measures, people's incomes and so on and so forth. So it's one of those things, I think, once we get out of COVID-19 and the looks of what's happening this week from government in regards to potential steps, and looking at it from a federal then state level, several steps being taken to try and relax some of the restrictions that are out and about as a means to start to take those first steps to get back to a normal. And I actually think we're going to reset a new normal going out the other end of this, but that's another conversation. But we look at what's happening in the marketplace, and if those things relax a little bit, hopefully the banks will then take a step back from the COVID-19 style of questions they're asking at the moment, and we'll start and get a rebalance of what credit looks like. So at the end of the day, if lenders don't lend, they don't have a business. So there's a balance in this, is you've got to act responsibly on responsible lending obligations. We'll be brokers under a best interest duty at some time. We don't have a time frame on that too, by the way. I know Jill's asked me a question a bit later on in this, that what is happening with that. Best interest duty at the moment is progressing, as far as the regulators are concerned, along its normal timetable. So that means in May, without a defined date in May, but in May, we should see the regulatory guide, the RG, for best interest duty. The implementation date that was tagged as being 1 July is still 1 July, but has been petitioned by everyone in industry to be extended. We wanted it extended 12 months. That may or may not happen. The current guidance is that that may be 6, 9, 10 months. It may not be 12, but we need more time because at the moment, everybody's focused on their mental health. Everybody's focused on having to work from home and the challenges that brings, let alone a new piece of regulation for the first time. We've then got to bump on top of that if they bring that in too soon. The government is being very considerate of everything doing, and again, they've got huge amounts on their plate. And I think our government has done a fantastic job in regards to handling the whole COVID period. And we can all argue things can be done better, but I reckon they've done a great job. You'd hate to be in their position in a period like this. It'd just be devastating personally, as well as from trying to manage a country, which is a business. So we'll wait and see what happens with that. The other questions we've got here, Linda asked why the lender's asking so many questions specifically about COVID-19, and does the borrower have a plan as they go forward with their repayment and so on. I guess they're reasonable questions a lender would ask, and the reality is they're all trying to get comfortable. If I lend you money, I'm going to get it back, because again, all lenders are in the business of lending money. If you don't lend money, you don't make money, you haven't got a business, you're out the door as well as a business. So they want to lend money, but at the same token, no lender lends money without an understanding of how they're going to get it back, whether that's P&I, whether that's interest only and it's going to roll into a P&I where it's interest only because it's a bridging finance, so there's an exit there, whether it's interest only because this person has this particular borrower has a portfolio of properties that they buy and sell, so they may be looking to sell it in 3 years' time. All these sorts of things. No lender lends without an understanding of how they're going to get their money back. And it's just difficult at the moment when we're dealing in a time unlike any other that, yes, there are more questions being asked, and that's not always palatable. With interest only as well, we know the conversation through ASIC or APRA, whichever way it was, says that, that people getting interest only is not necessarily a breach of responsible lending. And we did have a period where interest only lending was really on the nose, and we've sort of come out of that. And I think banks are far more open and lenders are far more open, so long as they know how they're getting their money back. What the plan is that at the moment there is a lot more reasonableness as to why interest only should be considered. And I don't know if the banks really want to push that though. It's something that I guess is individual per lender, and you need to speak to the individual lenders about that and make your decisions that's in their best interests as you go forward. I have a question here around valuations expire, which I touched on with AFCA a little while ago. This is a real tough one. I mean, lenders all I can tell you about lenders in the past, where there has been a decline in property values and people have pending loan approvals or pending settlements, have revalued properties. This has happened in the past. It creates an almighty uproar, so don't get me wrong. And at the moment, what we need to do is to get out of this lockdown period we're in as soon as we can, to make sure that we can stimulate the economy to ensure that these sort of things don't have or have a minimal impact on the value of properties, because the slower things stall, it's going to pull property values down. And obviously we can't come out of this situation until it's appropriate to do so, because we will be in a position whereby we could have a second round of this pandemic in this country. So it's a real delicate balance between health and economies. But we would be, it's something that's going to be difficult in that regards as to how valuations will be treated. And certain markets are going to pull back. I know where I am, there's a slight decrease. Other markets are staying relatively buoyant. Other markets have had significant increases, so decreases, I should say. So, yeah, it's just one of those tough calls that we've got to go through in this period of time, and we hope that there is minimal impact to there. I'm really concerned with this particular area, which is why I brought up with AFCA, that people's deposits are on the line, the fees they've had along the way, and they're paid for. are all at risk if lenders pull out a settlement. One, because they can, two, and that's law, folks. I mean, they've been able to do that since I started lending back in the late 70s and 80s. They've always had that right. Whether we like it or not, that's business. But at the same token, you taking advantage of circumstance, I don't believe is right. Also, when we look at people's incomes changing because of COVID, if it's temporary basis, I think that needs to be accommodated appropriately. That shouldn't just be an automatic you're out. Then of course we've got property values, and that one hopefully we will see stabilisation in marketplaces, and we will watch and wait with that with interest. But again, I think this is where lenders and ombudsmen need to play additional piece as well, because it is an impact of something on a global scale. It's not like anybody's done something wrong. Anyhow, we will watch and see on that one. The last question I've got here, or second last question I think I've got here, depends on the one that's just come through to me, is the interest margin charged on a residential loan still warranted, or investors subsidising owner-occupier loans? I don't know if that investors are subsidising owner-occupied borrowers, but if I go back to, I helped establish Rams Home Loans' first sales office in 1993. I'm going back a while. And in that period of time, there is at least 1 to 2% imbalance between owner-occupied rates and investment rates. And when Rams was there, and it was also the days when Aussie were gaining their ground, and so on, and the other non-bank sectors were coming involved. We're all going out the market saying it's the same rate. It's residentially secured, so interest rates are the same. And I believe the risks are fairly similar. The banks may want to argue that. So I personally don't believe an imbalance between an investment loan and an owner-occupied loan that are both secured by residential property, that the interest rate should be different, as far as I'm concerned. I know the banks won't agree with me, but that's okay. I believe they should be the same. I don't believe one subsidises the other. I just think somebody likes to make a bit more profit out of one than the other. They probably think the investor's making money and profiteering from it, so they're going to make a bit more as well. I think these things should become balanced. So long as the risk is the same. And when I talk about the risk, the security risk is an owner-occupied home, a residential home, sorry, I should say. So if it's a residential home, it's a risk, then I do not see that it should be an imbalance in the actual interest rates at all. It's different when the security risk changes, so if it's commercial or whatever, that's different again. So I just quickly, and sorry, I'm looking at my phone here, I've had some questions come through to me. They've been quickly texted me. Let's have a quick look here. We've got, so a question here is about when we're looking at scrapping clawbacks, or at least putting some parameters to protect the brokers when a loan is not paid out 24 to the broker. And that last piece is a key piece. If a broker does something wrong, so if you break the law, if you breach your contract, you commit fraud, whatever it is, you're going to lose your trail. You're going to get a clawback. You own that as much as we own any of our mistakes that we make. If a loan refinances within the first couple of years, it's not your fault, and especially with the incoming responsibilities around best interest duty, I've always been in this view, but even more firm in this, that you shouldn't be impacted by clawback if you're acting in the best interests of a client. Now, I have mentioned this on the last couple of seminars last couple of series that we've done on this. So you'll see other commentary. If you go to our YouTube channel, the FBAA YouTube channel, you'll see the past episodes of Q&A with Whitey. We've spoken about this before. We are looking at a research piece that we're doing on this to mount an argument to government, because I'd rather have government use a lever on top of the lenders to say that if a loan repays within the first 2 years, then a clawback shouldn't apply. You've done your job. And if we look at the legalities of it, your job was to get a loan settled, find a client, settle a loan. You did that. You're meant to get paid all of this money. Forget the quantum. But out of that, you only got half, and that's the upfront. And that other half, you're paid on a drip over time. And it's not just a short time, it's a long time. Now, sure, if a loan goes on for a fair bit of time, you wind up in a better position overall. But the legal position overall is day one, you were owed all this and you didn't get it. So you only got half and the other half put on a drip. So to risk that half of which was only half of your entitlement for 2 years for a clawback, to me makes no commercial common sense whatsoever. Completely against it. And I know there's various debates and arguments around it, but this is my view of the world. I'm against it. You did your job, you got paid. No one should have your hand in your pocket for 2 years. So anyhow, we're going to do our research piece. I'm going to go hit government up, because government, when I challenged them on this at the latter part of last year, basically told me to go away. I know where their pain points are in regards to that conversation. I know the data they want to see before they'll probably think about it again, or at least let me have another conversation with them again. I'll get that data and we'll have another look at it. Let's have a look else we've got here. We watched through the media, it looks like that after lockdown, job markets will be higher employment from home. What do you think it will impact on income? So when we come out of COVID, I guess, with the employment market, it's whether, I don't know whether or not jobs will be higher than what they were prior to COVID, or we get back to what we were and they keep building. It is interesting, the dynamics of new industries developing within the COVID environment to do other things than what they normally do. So when things get back to normal, it may well be the case that employment has gone up a bit because of diversifications of other businesses doing things that they don't normally do. So when we come out, they've got to do all the old stuff they used to, and if it's viable, they'll continue doing the new stuff they're doing. So it may mean that there's an increase in employment post-COVID. So that could be a good thing. We'll see what happens there. There's a question here, and sorry I paused for a minute. There's a question about what happened in Melbourne last week. Sorry, I'm just reading it. Look, I think it was an enormously tragic accident that happened there. The lives lost is just horrid. The driver involved was not an FBAA member. From what I can see, they were running a little bit of a rogue operation somewhere, as far as they weren't a member of anyone at the time. The comment here is, how do people with long criminal records continue to operate as a mortgage broker? Damn good question. And they damn well shouldn't be, as far as I'm concerned. Like I said, we have very strict due diligences on our memberships and on our reviews of memberships. And look, it's a number, it's going to, and sometimes one slips through the crack. It's very, very rare for us. And I spoke to our leading regulator on the weekend, on Anzac Day weekend, and I sent an email to the highest point possible within ASIC and got a response the same day, which was enormously appreciative and not expected. Our regulators are onto it. They will look at it. They've got to work within their terms of reference and the laws that they work under. I dare say that we need to always watch how vigilant we are, and that goes for all of us. It's not just me, it's not just FBAA, it's all of us, and all the stakeholders in the industry. And we God willing, we don't see something like this again, and terrible circumstances. So I think we need to leave that alone and to move away from it and treat it as a really bad story, what it is. But the more we give it oxygen, the more we talk about it, the more it festers. So, and that's not being disrespectful for those that lost their lives either. There needs to be, the appropriate considerations to their families and respect to them as well. So look, it's 12:30. I'm getting a wind-up signal electronically. So thanks everyone for joining us. Now, make sure you register for next week. Next week's going to be a great conversation. We're going to be talking to a great broker who has a fantastic business, and we're going to drill him for his tips as to what he does within his business to make him so successful, and especially within this time and this year that we're in within COVID. And we're going to be talking to George Samios of Mad Loans. And I'm really looking to George. He's a lovely, lovely man, an industry gentleman, got a fantastic business. Let's see what we can drill from him to get some tips to grow everybody's businesses. And we'll get him in on the Q&A as well and get him answering some questions as we go. So we'll look forward to next week. But once again, I need to thank our sponsors. They back us, and we love their support. They do great things in our industry. Make sure you check out what they're doing at the moment. You know, of course, through COVID, there's very different things with different lenders. They do this, they don't do that, whatever it may be. Check it out. Look at what the options are in the marketplace. Don't take a blanket approach to lending, and make sure you look at the options around the marketplace. Well, that's it from us today. Thanks for joining with us. Don't forget, you're going to get an email shortly. We want your feedback, and also you'll get your code for the CPDs for this session. Thanks very much. Appreciate you being with us. Have a great week, and I'll look forward to seeing you next Thursday at 11:30. And make sure you got your coffee and your morning tea ready. Speak to you then. Bye for now.